This time, it is truly securities lending live on Saturdays, fundamentals. So I'm Roy Zimmerhansl, and in this video, I'm going to answer 3 questions. What is it? Who does it? And why does it exist? Today is the first in a series on fundamentals of securities lending. This is the 3rd live Saturday that I've done. And I've had quite a lot of feedback from the previous 2 weeks where people have said that some of the things I was talking about was too complicated, and could I strip it back and begin from the beginning? So I apologize to many of you that have been watching in recent weeks. You will be experts yourselves in various areas, but even if you are, I think that sometimes people get benefit hearing someone else take a different perspective, or maybe you're focused on one part of the business and you could benefit from learning another part of it. But again, up to you. What I'll probably do as well in the notes over the coming days is I'll also put some chapters in it, so it'll be easier to navigate through this and subsequent videos. Okay, so look, what we'll do is we'll get right to it. I will set this up so I can share my screen, and we will get started without me waffling on anymore. If there is anyone in the audience, can you tell me that you can still hear me? And appreciate that. ML, whoever you are, thank you so much for sticking with this and giving me the feedback. So thanks for that. Let's get started again. Fundamentals, 8 sessions at least, starting today. Always at this same time, 1 p.m. BST. This is what we'll cover in those 8 weeks. Why does it exist? The characteristics and statistics of the business. Then we'll go into who the players are, the stakeholders, and the structure. Week 4, we'll look at sort of trading and performance measurement. Then we'll go on to collateral. So I'll touch probably on all of these topics to an extent each week, but there'll be a different focus, different primary focus every week, so that you can get a deeper understanding in that week while I sketch it off. And what you may want to do is save the date every Saturday at 1 p.m. After collateral, we're going to look at risks and mitigants, because this is a risk-oriented business. I would argue it's a very low risk-oriented business, but nevertheless, there is risk. But there's lots of mitigants along the way as well. Then we'll talk about the regulations that govern this business, and then at the end we'll wrap it up, bring it all together, and see how all those pieces fit with each other. So that's the agenda. We may interject other weeks in there, so this might be 10 weeks or whatever. But time will tell based on feedback from you. So. As I said, we're going to look at 3 questions. What is it? Who does it? And why does it exist? Let's just get straight to what is it? So securities lending is a temporary transfer of a stock or a bond between 2 investors. Those investors could be retail investors, they could be hedge funds, and they could be anything in between. So we'll talk about who in a moment. But what is it? It's temporary. What do I mean by temporary? Well, if I'm an owner of an asset and you tell me you want to borrow it, I'll go, well, that's great, but I want it back at some point in future. And when is that? Well, that's whenever I want it back. So if I lend it to you today and I want it back tomorrow, you have to give it back to me. And by the same token, even if I'm happy to continue lending it to you, but you're done borrowing it, well, you're going to give it back to me. So it's just like borrowing cash. If you go to your bank and borrow cash, they'll put a term loan, they'll lend that to you. They'll probably take collateral, because they want to be certain. And so think of your home. Your house is the collateral against the mortgage loan that the bank makes to you. And While you've got that loan, there's a fee. You pay them interest on the money that you've borrowed from them. So that's the same thing in securities lending. It's temporary because at some point that loan will end. Either the lender or the borrower will be finished with that loan, it will end at some point in the future. There will be, because it's temporary, there's also no capital gain. So if I'm the owner of the asset, I lend it to you, and you give it back to me at some point in the future, well, I'm in the same position I was in, so there's no capital gains taxes here. That's, it's not part of this. So you're tax exempt from that part of the transaction. Also, if I'm the owner, look, what if there's a stock split, or what if there's a dividend? What happens then is, because I've given the asset to you, and I don't know what you do with it, because you're legally able to do anything you want with it. That's legal. Um, so if I'm expecting the company to pay me a dividend, but I've loaned it out to you, I'm going to come to you and say, give me the equivalent amount of dividend, and you have to give me that amount of money. So I'm still in the same economic position. If there's a stock split and that stock is, I lent you 100 shares, and it was a stock that they did a five for one split, and that's interpreted differently in different markets. But let's say that 100 shares, when I lent it to you, is now worth 500 shares. Well, you have to give me back 500 shares. So you have to keep me in the same place that I started at. I have to have the same economic position as I did when I began. The only thing that you can't replicate financially is a vote. Voting's a little bit more complicated, and I'll talk about that in future weeks. But for now, the borrower has to make the lender whole economically, really, on all counts. Now, because there's risk, just like with the bank lending you money against your house, and they take your house as collateral, there's collateral in this transaction as well. So, first of all, I probably will only trade with counterparties that I'd probably do other business with. So I have a relationship with you. I know you. I trust you corporately. And so I'm going to focus all of my activity on you, right? So that's the important thing. I'm happy to deal with you. But of course, I do carry credit risk. I don't know whether you'll be in business tomorrow or next week or next year. And even if you're good and everything's fine in your department, there might be another department where that doesn't work so smoothly. And because of something nothing to do with the borrower that I'm dealing with, somewhere else in that company, they do something, or they have bad luck in business and they're out of business. So, as a protection against that, I'll take collateral from you. Right. And every day I look at the collateral and I look at the value of what I've loaned to you, and I make certain that I have enough collateral to keep me satisfied. So, just like any other kind of a loan, there's a lender and a borrower. They check each other out from a credit rating perspective. They take collateral against the transaction, or give collateral depending on which side of the transaction you're on. And there's a fee paid while it's being borrowed. Someone many years ago gave me the example. It's kind of like a house. Imagine you buy a house, and you're buying the house not to live in, but you're buying it as an investment because you think that house will grow in value over time. Uh, and so you're happy to wait for that to grow. In the meantime, it's sitting empty, and someone comes along and says, "Hey, I would like to rent that house from you. You'll still own it, but you can earn some extra money from it." And so you go, "Yeah, that's a good idea." And you make certain that you think that they can pay you the fees along the way, the rental value. And all of a sudden now you own the house, you have people living there, and they're paying you rental value. So, although it's not perfect comparison, it's a pretty good example of taking an asset and trying to improve your returns from it in a secondary way, because your main way is you're hoping it goes up in price. So that's what securities lending is. Okay, so that's what it is. I'm just going to take a quick drink. It's a good thing I like talking about securities lending, because this is the second time around today, right? Okay, so who does it? Well, the answer is just about everybody. About a third of the institutional assets in the world are available in securities lending programs. So about $25 trillion worth of assets are available in lending programs. And the lenders, the owners of these assets that rent them out, include mutual funds and ETFs and pension funds, but also retail investors. So it's really anyone that's trying to improve the returns from their portfolios. And what I've put up here is some examples of institutions where they're actively involved in either lending securities or borrowing securities. Okay. So the lenders, so people often have never heard of securities lending, or if they have, they don't really know about it in detail. And so I always tell people, look, if you have a mutual fund or an ETF or even an insurance policy, or if you're part of a big corporate pension fund, if you have all of those, then it's pretty likely that somewhere in that mix, you're doing securities lending already. You're getting exposure from the returns in securities lending, whether you know it or not. So many mutual funds do securities lending, and they're amongst the longest serving community of lenders. ETFs, as they have grown, ETFs often are part of the securities lending program because it generates fees that allow them to lower their operating costs or reduce the tracking error to the index that they're trying to match. And in fact, if you've heard of these zero fee ETFs, a lot of them are very dependent on securities lending revenues to be able to maintain that zero fee requirement or commitment to their investors. So it's really a critical part of that. Pension funds, big, large, long-term investors, where small incremental gains year after year after year compound and make a real substantial difference to the returns that they make over many years and decades. Okay, so lenders, big institutional investors, all the way through to retail investors, going through firms like Schwab or Webull or Robinhood, right? So, but more firms than that. I'm just obviously just giving you a few examples. So lots of access points, lots of ways to actually get into programs, uh, and lots of revenue. Again, to very briefly, the fees that lenders make on an annual basis are around the $10 billion a year in fees. So it's a pretty substantial business. Now the borrowers, they include, as I say, hedge funds, banks, securities firms, um, uh, retail firms. So it is really quite a range of market participants that are involved as borrowers. And I'll talk in a minute about why they're actually borrowers and what the different incentives are, because different firms can have different reasons at different times. A quick question that came in: how much of the revenue is passed on to the owner of the security, and in what way? Um, Unfortunately, what you'll find the answer to a lot of securities lending questions is it depends. And I'm not being facetious there. It does really depend. And that depends on things like the size of the relationship. So, like with most businesses, the biggest investors often get the biggest fee split, but it works in a fee split way. So, imagine the borrower is paying a fee to the lender. Now, although mutual funds and ETFs and pensions and insurance, all those people might be the lenders, that's legally the position because they own the asset and it's their asset that goes to the borrower. Now, typically, most institutions aren't structured to operationally run securities lending programs. So they hire intermediaries. So it might be their broker, like if you're with Robinhood or Schwab or Webull, your broker would deal with that, and they might pay you a fee, right? Part of what they collect. So and that will depend on individual economic arrangements between the retail investors and their brokers. At the institutional level, the mutual funds, ETFs, again, they'll typically have custodians that will lend on their behalf. or they'll have specialist intermediaries that aren't their custodians that lend on their behalf. And there are some that do it themselves. So BlackRock is an example of a firm that does it themselves. And so they have replicated or set up similar securities lending departments within the organization. And the BlackRock funds, or in the case of Vanguard for some of their funds, they do the business for their funds. So there are examples of institutions that set up professional divisions to run this on behalf of their own fund complexes. And Fidelity recently announced that not only were they going to do it for their own funds, but they were going to take external funds and do it for those funds as well. So effectively, they operate as a commercial venture. They take fees, and the fees are paid by the owner of the asset. They aren't, when I say paid, really what happens is the securities lending intermediary keeps some of the fee that they collect from the borrower and passes on the rest, whatever their commercial arrangements are. So I hope that answered the question, but it's a good one because technically there's a couple of different ways that those fees get collected. But again, that's too complex for this kind of baseline introduction. We will talk about it in future weeks. Now, the borrowers, as I said, hedge funds, banks, securities firms, retail firms, all with different reasons and different times. So I think what we'll do is we'll just go quickly on to why does it exist, right? And so why do borrowers borrow really is the question here. There's three reasons why lending happens or why borrowing is needed. And the first is to smooth operational inefficiencies, as I said. So, what does that actually mean? What I mean by that is that imagine I'm a securities firm and I've sold a stock to another securities firm through a stock exchange. And for whatever reason, uh, I don't hold that stock. I bought it from somebody else. I bought it from somebody else at this price. I've sold it to them at that price. And for whatever reason, the person that was supposed to deliver me the stock hasn't been able to. They had some kind of an operational problem. Maybe their customer let them down and didn't get them the stock in time. Maybe they used it as collateral for another transaction and they haven't freed that up yet. So for whatever reason, they haven't been able to give it to me. So that's my problem, and hopefully I've got some controls to manage that risk. But because I haven't got it, I now can't give it to somebody else, whoever bought it from me, and who knows what they're doing with it. And if I just carry on waiting for whoever is supposed to give it to me, before I can give it to them, you all of a sudden now have a systemic problem potentially where now there's two firms dependent on that transaction, that somewhere downstream they have a problem. And if that entity turns out to be Lehman Brothers and they've gone bust, well, now there's two firms that have a problem here. So by operational efficiency, if it's late coming to me, what I can do is I can borrow it from somebody else and satisfy that leg of it. So again, now if the entity that owes it to me is Lehman Brothers, then at least only I have a problem, and I only have a problem on one leg of it. I don't have a problem on this end and that end because I've taken care of that. So it kind of, if you imagine that there's thousands and hundreds of thousands and millions of transactions around the world every day that have some kind of an operational problem, securities lending, the ability for someone that hasn't received an asset or has a problem delivering an asset, the ability for them to borrow is really fundamental to making markets operate operationally, functionally, smoothly, and reduce the risk in the day to day kind of plumbing and piping of the business. So, very much used for that. So that's the first one, and that's really the history, and possibly by transaction volume, that might even be the biggest number of transactions that are generated. But there aren't statistics available on that. So that's one thing. The second thing, which most people talk about, whether they talk about it in a good way or bad way, it's to enable short selling. So let me just take another quick drink. So short selling, and again, maybe we'll even do this in future, but short selling is when an investor decides that they think a stock is overpriced for whatever reason. It could be many, many different reasons. They think it's trading today at 20, but really fundamentally it should only be trading at 10. And most people are familiar with the phrase buy low and sell high. So you could buy at 10 and sell at 20 and you've made a profit of 10. The opposite also holds true. You can sell high. So it's selling at 20 today, and I think that's overpriced and I think it'll drop. So I'll sell it today at 20 and I'll buy it back when it drops below 20. And so I'm kind of selling high, then buying low in future. So that's really what short selling is. Now, legally, in most markets around the world, before I can sell it at today's price, I need to be confident that I have someone that will lend it to me because of that problem I said before. If I just sell something I don't own and don't deliver it, well, that's a problem because what if I go out of business? What if I never deliver it to the person that bought it from me? That would be a problem in the system. So, regulators in most places make me be able make it a requirement for me to find where I can source assets to be sure I can borrow them before I can do that short sale. Okay. So we're not going to talk about whether short selling is ethical or moral or good or bad. We're not going to talk about that today. We might in future, but today it just is. So 30% or 40% of many markets turnover is short selling. So it's a really important part of the business. And securities lending exists partly to satisfy the need for those short sellers to be able to source and locate available shares and bonds before they can do short sales. So it enables short selling. The third thing is meeting regulatory liquidity obligations. So that's a very long way of, or not that long, I suppose, a long way of saying that regulators realized that when money markets and the liquidity of markets froze up between 2007 and 2008, that really what part of their regulation should focus on is what happens to banks if money markets freeze up again and they can't borrow money from anyone for 30 days. So there's a series of regulations that have come in over the last sort of 10 or 12 years that make banks have kind of stockpiled liquidity so that if the markets freeze up, they can access those assets and that liquidity to keep operating. So it's a really big protection for the system to make certain that banks can keep operating in a 1 month sort of frozen environment. And part of the way that banks and securities firms can satisfy that liquidity requirement is that if they don't own the liquidity, where the assets that qualify for liquidity, like government bonds, what they can do is they can borrow them and they can hold on to them as liquidity buffers. So they can take an asset that doesn't qualify from a central bank or a regulator's perspective, and they can use that as collateral to get in assets that do qualify for those liquidity buffers. So that's a very big part of it, and that's what I mean by meeting regulatory liquidity obligations. So I'm just going to really try to summarize all of that for you as we come up to the end of the second 30 minutes, except this one was sound. We thought we'd give that a try. So what is it? Who does it? And why does it exist? So it's a temporary transfer of a stock or bond between two investors. It's collateralized, and that collateral gets checked every day and the value of the stock gets checked every day, so that if I lend you a stock that goes up and up and up, Well, the collateral that I got from you on day one might not be sufficient anymore. So we always value the stock or bond and the collateral we're holding and make certain that it gives me a sufficient level of protection that I feel like if you go out of business, I can still sell my collateral and buy back the asset that I lent you. So temporary, collateralized, and there's a fee paid by the borrower to the lender. And as per the question earlier, if there was if there's an intermediary involved that's actually doing the day-to-day work, like the collateral valuations, um, what what that means is that they'll actually collect the fees, they'll do the operations, they'll do the trading, they'll keep some of the fees, and then they'll pass the remainder of the fees on to the owner of the asset. Who does it? Look, there's thousands of institutions, and if you include retail investors, probably millions of people around the world that are involved in this business. And whether they know it or not, you know, who knows? But certainly, thousands of institutions, and indeed millions of people that go through their brokers that actually are aware of it. You know, it's not just in the U.S., but it's commonplace in a number of countries where retail investors can benefit from fees they get for lending out stocks that they'd be holding on to anyway. And then why does it exist? Three reasons. One is to improve settlement efficiency, reducing systemic market risk, just making the markets a little bit safer, a little bit more secure, and a little bit more operationally efficient. It improves the liquidity because it enables more trading activity to happen. And while it facilitates short selling, it also facilitates what we call market making, where firms act in the middle, where if there's a buyer that wants to buy and there's no one that wants to sell it to them, a market maker will say, well, I'll sell it to you, even though I don't own it, because I can borrow it from someone and sell it to you. So it helps, you know, buyers access stocks that they might not be able to get in other market conditions, or be able to get them at a cheaper price. So it improves liquidity. And then finally, it helps banks and securities firms and dealers access liquidity buffers to satisfy their regulatory obligations. Again, making it a safer capital market infrastructure tool. So, securities lending is in some cases actually entrenched in regulation as being described as an efficient portfolio management technique because it's kind of like a fund manager who says, well, I can deposit excess cash at this bank or that bank, and that bank pays a higher interest rate. So I'm going to do that. Or I don't like the commissions that this broker charges me. So I'm going to go somewhere where there's better commissions. So all of these things incrementally make improvements to the overall return, and securities lending is very much like that. This is a way to get relatively low risk, relatively low fees, uh, whether the market's going up or whether the market's going down or whether it's going sideways. It's a way to generate very low risk income that accumulates over time. So, very much an efficient portfolio management technique. So, look, I think that is uh, what we're going to be talking about. This was the first in the series. If you can forget about the sound problems, if you think this was actually beneficial, would love it and appreciate it if you could give us a thumbs up. If you want to be reminded about future ones, don't forget to subscribe and ring the bell so that you'll be notified every time that there's an upcoming broadcast. We have a huge amount of free information on our website. Um, and that is, I'm showing that now, www.pierpoint.info. So there's lots of blogs, there's podcasts, there's all kinds of things you can learn there. So that's pierpoint.info. We have training, because as I said, I've been training people since the early 90s. I'm still doing that. We have free courses as well as paid for courses. So feel free to learn more about securities lending and more about repo. And then explore some of the other courses that are paid for, where we go into those topics in much more detail. And we also have a course on collateral management as well. And if you are super keen and you want to, actually, let me show you this one. If you want to benefit from tutorials, premium editorial content, and a community forum where people share information and ask questions, we also have something called the Pierpoint Alpha Community. And again, you can find more information about there on that URL. But look, go to pierpoint.info, find out what actually will help you, give you more information. Next week, we'll be talking about characteristics and statistics. So we'll go into some more meat and explore, who is doing how much. So I've talked about big segment level information. We'll break that down and we'll look at some of the numbers involved. And that is next Saturday at 1:00. And I promise you, I will actually look at the sound and sort that out before I get started again, because it did look like I was having sound the first time around, but I wasn't, clearly. So thanks again, everyone, for that stuck with us. If you're seeing it on replay, you've been able to fast forward through those problems, so lucky you. Give us any comments or any more questions in the chat, live or replay. Thanks again. Have a great Saturday, and I look forward to seeing you next week. If you're really keen about exploring it in more detail, I suppose I should mention that we also do a live stream on Wednesdays at 10 a.m. That's on both YouTube and LinkedIn, and probably Facebook from now on. So that is, we do that every Wednesday. That's much more detailed, and we take an hour to go through the issues there. But feel free to join us live for that as well. That's it. I'm Roy Zimmerhansl. Appreciate you being with us, and thanks, and goodbye.